I love talking about Google. Guys, it's up 11% in the last week. They announced earnings. We're going to go through it. We're going to go through a lot of stuff with Google. We're going to go through the major metrics of it. We're going to go through the 8-pillar process, some news, some bull and bear cases, analyst estimates, and finish it off with our stock analyzer tool. And there's something in this video for everyone. Whether you're a beginner investor or an advanced investor, it doesn't matter. And if you are a beginner and it sounds a little confusing, stick with it. It won't take long. There's a reason why we have thousands of people in our community. And guys, if you want to talk with me more about investing, join our community, follow me on Twitter. I'm very active there. Let's go take a look at Google, one of my favorite companies to look at. All-time high of Google, $152.10. And it went as low as $83 back in November, the day before Facebook hit its low. And now 52-week high just the other day of 134, and it's currently at 132.98. Mo, we're on YouTube. The two top search engines in the world are Google and YouTube. And guess what? They're both owned by Google, Alphabet. They're both owned by it. Over 5 billion videos are watched per day on YouTube. And that was from 2 years ago. So imagine what the number is today. It is an incredible, incredible company.
Yeah. I can't remember what it was I was doing over the weekend. I had never done it before. And I was like, I'll just YouTube it. And there it was.
That's the amazing part. Like, I thought there was a great advertising campaign that Google did 2 years ago where they talked about like, this guy now has a PhD and it all started because he YouTubed something. You know, Google and YouTube are both verbs now. Google it, YouTube it. That's the incredible part. And TikTok has done very well, but the whole TikTok mania has started to die down a little bit. People still go to YouTube to learn. People still go, guitar, look, you're pulling up guitar stuff. Remember when you are playing guitar? My guitars are all in stores now because we're moving, but I can't wait to get back into guitar. And whenever you want to learn a song, you just go to YouTube or you Google the song and the YouTube videos pop up. This is an incredible moat. What are you smiling about?
I just Googled something random. Drilling into a rock.
How to drill a hole. Incredible.
How to drill into a rock.
That's incredible. With 19,000 views, 14,000 views, 2.4 million views, 39,000 views.
First time I've ever Googled that, but you can find anything.
What made you even come up with that?
Just thought of something random.
Yeah, but where's the thought process?
I don't know.
All right.
That's what popped into my head.
So
that's what goes into my head, guys. Scary.
Let's go look at the numbers right now on Google. Market cap, 1.69 trillion. Market cap is buying every single share outstanding at the current market price. So if you want to own 100% of the shares today and you could buy them all at once, you'd pay 1.69 trillion. Now, enterprise value happens to be the exact same thing, but that's not usually the case. Enterprise value is market cap plus all the debt on hand, less the cash. So what this basically means is Google has basically no debt on it when you zero out the cash. Do they have debt? Yes, but they also have cash to offset that. Now, revenue of $290 billion in the last 12 months and profit of $61 billion in the last 12 months and free cash flow of $71 billion in the last 12 months. They have more free cash flow than they do profit. Now,
pretty good amount more.
Absolutely. 1-year P of 27.7, 5-year P of 32. Is this too high? I don't know. Guys.
We just talked about it being such a moat.
Yeah, it's a moat. And guess what else? They have a really high return on invested capital, 15%. What this means is when they invest money into the business, they get a high return on that. You should pay more money for high moat businesses that have a high return on invested capital. If they're able to take the money that comes through the business and invest it at higher rates of return, that's going to make you more money down the road. It's just like you're at home and you generate cash by going to a job. What you want to do is invest that money to get high rates of return to increase your net worth. It's no different here. They're going to be able to invest their money at 50. Imagine if you at home knew you could take your money and invest it at 15% returns. How rich would you be? That's what Google's doing. So with that, you should pay a premium for that. For that reason, and they're a moat business. Top 2 search engines in the world. Profit margin, gross margin of 55%. That means for every extra dollar they bring in, they generate about 55% of that to the bottom line. And the bottom line margin in the last 5 years was 24, and it's a little bit lower now, about 21%. So that's some high level things. All right, Mo, why don't you go over some of the news of this company, the bull and bear cases, and then I'll go over the 8 pillars after that.
Okay, so some bull cases, they're expected to generate $700 billion in free cash flow over the next 6 years.
Geez, OP, that's 115, that's 115, $116 billion a year in free cash flow.
So that's a lot.
Holy cow.
Isn't it amazing? These guys just print. Maybe they have the printing machine.
They have it. It's not the Fed.
Yeah. Wow. Cloud revenue is doing around $30 billion in sales for the last 12 months and $8 billion in free cash flow. And it's expected to do $51 billion in sales and $16 billion in free cash flow into the future.
Okay. Those are 2 bull cases. Remember, guys, the stock is up a lot from its lows. When the stock was at 83, 84, 85 bucks, what were we hearing about Google?
Dead.
Oh, they have to lay people off. Things are going poorly. Okay. Now it's all of a sudden things are great.
So here's some bear cases, and remember, these are what we pulled from what the opinions are. Ads make up 78% of revenue. This segment is only going to grow by single digits as spend softens. So I think that's kind of short-term thinking.
Exactly. So I'm looking at this, hearing this bear case going, okay, guess what? Even if it grows at single digits, I want people to think that's terrible because they still have $270 billion in revenue. I'm okay if it grows at single digits for a long time, forever.
Right.
Go ahead.
Expectations that Google will buy back $500 billion of stock through 2028. And again, this is
not either good or bad. It just depends on
if they're buying it back at a good price or not.
Guys, that's super important.
That's really it.
That's a bear case if they're overpaying for expensive shares. It's a bull case if they're buying back cheap shares. Correct. Hypothetically, if the company went to $40 a share tomorrow, I'd want Google to spend every extra dollar of free cash flow buying back those shares because that would give me as an investor, if I were an investor, more ownership of the company. Let's say Google had 10 shares outstanding and you owned 1. If they bought back 4 shares down to 6 shares outstanding, you still own 1, but instead of owning 1 out of 10 shares, you now own 1 out of 6 shares, which increases your ownership percentage from 10% to almost 17% by doing nothing. By doing nothing. Hell, you want them to buy back all the way to 2 shares. Now you own 50% of the business by doing nothing but owning your 1 share. That's how companies like NVR and AutoZone increase the price of their stock many, many magnitudes higher than their profit and their revenue went up. They buy back cheap shares. That's the incredible part. Yeah. But sentiment has to usually be bad for that to happen, right, Mo?
Yep.
Okay, so let's look at some of the 8 pillars for Google, and it's exactly what we love. Guys, if you have our software, you can customize your 8 pillars up to 12 different versions and over 4 quadrillion different variations. Now, guys, what we're trying to do here when we find companies like this, these are usually very attractive businesses that's just about getting the right price, and they tend to be very popular, good, solid moats. We tend to see that in companies that we have just the valuation X's and the rest are all check marks, right? All right. So let's see what the analyst estimates are saying. Mo, you want to go over those?
Yeah, let's see here. Okay, how much? Oh, wow.
Yeah.
Okay. So $5.49 end of this year to $9.68 at the end of 2027.
So 70, 80% growth.
Yep.
Over the next, or whatever percentage it is, over the next 4 or 5 years. Remember, guys.
Mid-teens.
Yeah, mid-teens. This is better than Roku.
Yeah.
This is better than Roku is doing.
And this is a company that is
$280 billion in revenue, $290 billion with $1.7 trillion in market cap.
Yeah. All right, let's see what the revenue does. $309 billion to $442 billion.
Guys,
high single digits.
You have to remember, it's much, much harder to go from $300 billion to $400 billion than it is from $3 billion to $4 billion. As a company gets larger and larger, you have to factor in a lower growth rate. Have to. It's just very difficult to grow at high levels for long, long periods of time as you grow larger and larger. Okay? That's the very big key here that we teach on this channel. When I hear people say, oh, these companies are going to grow forever. Yeah, they will grow forever, but it's probably not going to grow at the same rate it did to get there. And so you can't factor that in. All right. So final thing to do here, stock analyzer tool.
Put a price on it.
Now, guys, we are doing a web class here on the 8th of August. It's very important. Sign up below for free. Our web class is actually going to go into more detail going through a 10K. How do you read and understand a 10K, the different parts of it, etc. This is something that's very important. We get asked this a lot in our community of investors here when people say, hey, how do I go delve more into it? So we're going to do that. Sign up below for free. All you have to do is just sign up at that link below, and you're going to be able to get into our web class. And the good news is you're going to learn something from it, and you're going to become a better investor because of it. So make sure you sign up. Now, our stock analyzer tool has been used well over 2 million times since we put it out there. It allows people to make assumptions about the future on a company, and then it spits out a price based on those assumptions of what you should pay, not including the balance sheet. Now, the good thing here is the balance sheet is basically perfect.
That's perfect.
So we're not worried about the balance sheet here. So look at this, Mo. First thing I like, increasing return on invested capital.
Yep.
Guys, this means as time has gone on, they've gotten better about investing the money in the business. So again, you should pay a premium for that. But we're going to put revenue growth numbers, profit margin, free cash flow margin, assign a multiple of earnings and free cash flow, and then finish it off with what return do we want to make? What margin of safety do we want to have in order to buy this company? And it'll spit out the price. So Mo, we're going to do a 10-year analysis. You can do up to 20. Give me some revenue growth numbers for Google for the next 10 years.
What do you think about 6, 9, and 12?
6, 9, and 12. What were the
estimates?
What were the estimates on 5 years for revenue growth?
Estimates for 5 years on revenue were
okay. I like this, and here's
I wanted
why.
to go 12 because if they start, as China opens up more internet, as India, as Africa.
I love it. So Mo was conservative, saying, listen, they should be able to grow revenue 6%. And let's say the world does better and Google enters some of their other bets, end up killing it. Yeah, maybe they make 12% revenue growth. But we can't bank on always the highest numbers. We like to put it in there to kind of give us an extreme version of what the price could be worth. Okay, what about profit margin? Because as you can see here, even though profit's down over the last 5 years, it's still in the low 20s.
I was thinking 21, 23, and 25.
21, 23, 25. Not opposed to that. Okay. And what about free cash flow? Because if you notice here, guys, what we love, free cash flow has actually been a little bit higher, except for the 5-year number.
For the 5-year.
So what do you want to do?
Based on the 5-year, I was thinking about keeping it the same.
I love it.
Yeah.
So we like to keep the free cash flow margin the same. Now, the only thing I would have probably done different than Mo here, I would have probably done 20, 22 and a half, and 25. But I don't blame Mo for this, and this is part of the art of investing. This is why it's nice to have this community of investors where people talk about it when they do their analysis. Now, what earnings multiple, what PE, and what price to free cash flow should we assign to the company? The way we look at this is the market average is going to be 15, but we'll go higher for a moat and a higher return on invested capital and higher growth rate, and we'll go lower for the exact opposite. So Mo, what PE and price of free cash flow do you want to assign to Google, the big moat that is Google, with a good return on invested capital that could be actually increasing as time goes on?
I'm debating between 17, 19, 21 and 18, 20, 22.
What about 17, 20, and 23 then? Okay. Because I think 23, even though it's high, talk about a moat, right? And I look at this thinking, I don't believe 15 is a fair PE for Google. And if you compare this to videos we did 2 years ago when you were looking for special situations and what multiples to put, we'd look for companies that, okay, maybe their revenue is falling like a Foot Locker. But now our focus has changed to bigger companies that have lower growth potential, but are growing and they have a set moat. You're going to hear the word moat from every value investor out there. So guys, we're going to do the desired annual return. Stay through the end of this video so we can explain all the numbers here. It's very important to understand our thought process, not for you to copy it, but for you to learn it. And as the things make sense to you, you will do a better job of applying this as you have our software. So Mo, what desired return do you want to do, knowing that this is our margin of safety and we went really high up here, so we need a higher desired return?
So I was thinking 10, 11 and a half, and 13.
See, I disagree.
I don't think that 12 is that high.
Wow, really? Okay, let's do that.
I can see them doing 12% revenue growth the more they open up to the world.
So the key there becomes at 12% revenue growth to the 10th power, that triples their revenue in the next 10 years. Triples. It's a lot, Mo.
Yeah, it's a lot.
But let's put it in there. But the other reason I like that is it'll show us, let's say, for example, we did this and the highest number is still red. It'll show how overpriced the company really is. So again, guys, I'm hitting the analyze button. Boom. A low price of 85, a high price of 157, a middle price of 116. So even on 12% revenue growth.
Yeah.
It's 133 right now.
Right.
If you paid today's price and the lowest assumptions occur, you're going to make about 4%. If you pay today's price and the middle assumptions occur, you're going to make almost 10%. Mm-hmm. And if the highest assumptions occur and you bought it today for 133, it's going to be about 15%. I have it on my watch list at 100. I'm actually going to change that. I'm going to add it to my watch list at 105. So now the software is going to notify me and by email and on my app and on this computer to tell me when it hits the price. Guys, webinar, August 8th. Check it out. Click the link below. Sign up for free. Learn more about how to do deeper due diligence with a 10K in your investments. Thank you very much for your time.